Edison, welcome back to the show.
Back, Oliver.
So let's talk some fundamentals here. We got a whole market that's been concentrated very closely on bonds. We got Powell talking to Congress today. He actually was talking crypto, a lot of the headlines that I saw. But do we expect anything new from the Fed chief? Do we expect anything from all these speakers lined up this week? Because there's a lot.
I think there's going to be absolutely nothing new that's going to come out of these speeches. We know the narrative, right? Low interest rates, the zero interest rate environment, at least from the Federal Reserve's perspective, all the way to the end of 2023. That's the narrative as of right now. The only tidbit of information that I'm looking for, and I'm talking about tiny minuscule hints at it, is any indication as to whether or not they're going to act ahead of that time frame if we see any sort of that demand surge that is expected post-pandemic, right? Once the full reopening does occur, once we're going to see demand and consumption skyrocket, so to speak. How is that going to impact their stance on low interest rates in 2023? That's where I think we're likely to see some of the markets participants really try to fish out some information from that context.
I'm looking at your notes right now, and it seems like your base case for bonds are flat, essentially, for the next year plus. Now, is this with a sort of assumption of a recovery in the economy? Do we need to see some serious economic potential being realized from the stimulus, or is this also an issue of supply and the Fed not adding on more to their bond buying program? Because there's some that would argue that even if we don't get real powerful economic growth, that we're still going to have higher yields because of the other side of the equation.
So I definitely think higher yields are going to be either a function of the higher growth or what you just talked about, the other side of the equation. It's really difficult to make an argument against a 10-year Treasury yield that's not sitting at 2% or higher over the next year, year and a half. And it is simply going to be a function of the reopening and of the consumption-based component. Even in an environment where, let's say, economic growth is not at pre-COVID levels, or even if it's not at pre-2020 levels, it's still very difficult to make the argument that yields need to be at lower levels than they are right now, where we can see 1% or lower. Fundamentally, that would not make sense. And if we do see it, that means we're in the midst of another recessionary type pressure environment that we're likely to see. It may not be COVID induced, although that's possible, but I would place a very minimal probability on that, where something else is brewing. Because if you look at the data, kind of broadly speaking, any push on the demand side, especially now with the new stimulus package, especially with the vaccination efforts that are happening from the White House, I think yields only make sense for the right reasons for them to be higher at this point, Oliver.
So when we look at the effects on the market, for the most part, this year has been very reflationary. It's in nature from the investment perspective. We're still kind of waiting for the inflation to show up in the data, but the market's already getting in the path of some of that growth, the cyclical rebound, all this stuff. Today we've got something very different. Bonds are rallying big. We've got tech showing up with a really great session here. It seems like, at least I would argue, some of this looks tied to headlines overnight and this morning that various countries are slowing their vaccination rollouts. We were talking at the top of the show about the debate in New York about what pace they're going at. Edison, as an investor, does one need to still monitor these day in, day out, weekly style short-term developments from the virus, or should we just concentrate that on a year from now what that scenario is going to be?
I think focusing on the short term is going to be nothing but a bias to actually get more defensive, when in reality, there's no need for that defensive component. Now I want to touch base real quick, Oliver, what you just talked about on, bonds rallying and tech is doing great today. There's this narrative that's been happening, right? This negative correlation that, tech stocks go up and yields go down and vice versa. And I think that's really, unpacking that makes a whole lot of sense, right? Because technology stocks were doing just fine back in 2017, 2018, when yields were near 3%. So to make the argument that they're not going to do better because of where yields are right now and if they rise, I'm not quite buying that story entirely. I think it's the fact that the vast majority of the market is so value biased that this kind of reopening, this aggregate reflationary trade is starting to cause this correlation to place, which correlation, causation, we can have that conversation all day long, but I just want to place caution there on that from that standpoint. On the inflationary front, I think inflation has gained a tremendous amount of traction over the past 6 months, and especially over the past month, given the new stimulus package that got released. As inflation does come into play, right, I would highly welcome it. I think the narrative and the rhetoric that inflation is going to skyrocket and cause bonds to lose tremendous value and stocks to also lose tremendous value. There's simply no real statistically significant evidence of that going back historically. And we looked at this going back 50 years and tracked the data and said, okay, what happens when CPI rises at crazy levels? And everything's very spurious. So that notion that inflation is coming down the road, great, so be it. We would be actually in a better environment in that 2.5% to 3% CPI over the future than we have seen over the past 15, 20 years, with CPI averaging well below 2%. And we have been arguably what has been one of the biggest and largest accommodative monetary policy periods in history, Oliver.
Edison, we're looking at a chart from a recent report of yours looking at month over month annualized CPI, and good luck making any sense out of this. It seems like, to your point, that there's not any real obvious correlation, at least looking at the sample set of data you have here that I believe goes back about 50 years.
Exactly. And actually, the argument that the data revealed for us is that you tend to have more volatility in that 2 to 3% CPI range than when you get above that. And everything I'm seeing right now is that there's this fear of a CPI above that 2.5%, 3% or 3.5% range. And what the data shows us is that everything is spurious in terms of volatility and negative returns after that. There are many other factors that come into play, anywhere from politics to geopolitics to concentrations in the market. So to make the argument that inflation alone is going to cause havoc to bonds and or stocks, there's simply no merit to that, despite how good it may sound from a conventional wisdom standpoint.
Okay. I like the data here, certainly reassuring. So far, though, we've gotten tech trading basically 1-to-1 with yields. So should we get ahead of that or wait till it tells us we're in the clear, Edison? Last thought?
I think getting ahead of that may make a little sense here, but not entirely. I'd say hedge it partially, but not entirely. I think the narrative is there. I think the tech stocks still make a tremendous amount of sense in the portfolios, but I would consider maybe going down the large cap into the mid cap scale, some innovative companies in there, and using that tech play as opposed to the mega cap, large cap tech.